Hey, morning, folks. This is Wednesday, the 7th of September. So, apologies for the slightly late recording, but by the end of the day, not really much that's happened. We're waiting in half an hour time. We'll be getting the Euro area quarter-on-quarter third reading on GDP. Um, so nothing much in terms of that because all eyes will be for tomorrow, the ECB set to release a rate decision. And also on Friday, we have the Euro area emergency energy meeting in regards to basically electricity, gas prices over there. It's just skyrocketing. It's really hitting consumers, businesses. So a lot a lot in store for the euro area, but what we're seeing here, what I'm just going to touch on for a bit, really, the usual sort of markets, is because usually they play around when we talk about global macro. They usually play around the same theme, and you get to use similar and how you read, well, how I look into reading certain types of moves into how you can sort of like prepare or what to look for down the line. So what's happened here is yesterday we dipped above 110s on the Dixie for a bit, pulls back, pushes some more today. And looking at this, you're asking why we're seeing this, the impetus being the ISM non-manufacturing that was released last night during the Wall Street session. What we saw to basically a pretty much in line from prior reading, but much better than expected. So they were expecting a drop, but that didn't come through. So basically, pouring fuel to the fire of a further hawkish Fed stance. So they're probably not changing their minds anytime soon. Understanding that prior to this, prior to Jackson Hole, there was this idea that okay, they might actually come around and cut in basically in Q1 next year, but that's obviously not going to happen now. Basically, the Fed's shown that they are resistant to the market wiles, so that's one. How does this translate? You look at demand. The idea is that the higher interest rate for longer, a more expensive dollar is going to hit demand, and which was why we saw the crude market, even though with 100,000 output cut effective October, we are seeing crude instead of closing up on the 88 again to further push. Nope, it didn't do that. It actually tried to go for 88, went further down, and now we've tested 86s and more. So this, again, speaking of the demand picture, higher interest rates, higher dollar, more expensive dollar. What does that do? The price of oil. That's why OPEC is basically cutting output in October to stabilize this market, because there is an impending the idea of, like, when you look at forecasts that demand destruction is going to come through. Demand is going to drop with the dollar rising, basically to control inflation. Hence, we're seeing this happen. So, if we get any better data of the US, chances are, today trade balance coming out, Canada, US, we had a slower, basically the export numbers for China slowing down due to that is just, output just getting boggled. So apart from that, everything's pretty chilled. We are looking at demand being the main picture. So it's slowing demand being the main driver of markets. Also, same thing with equity markets and all these things. So anything else, just hit me up in Discord room. This is Reed bringing you today's daily briefing. I will shave at some point. Cheers.